as the PPI shows inflation under control for now. Let's get straight to CNBC senior economics reporter Steve Liesman with the latest on the economic front. Steve, and some new comments from the president on Fed Chair Powell in the past hour.
Yeah, Kelly, while welcoming the lower inflation reports the past 2 days, forecasters are still puzzling over the mystery of where and when the tariffs are going to increase, and will they show up, if they do, at all. Producer prices well under control, up just 0.1 on the headline and the core, both better than expectations. That followed a tame consumer price report yesterday. Not surprisingly, both reports lead to an expectation of a very modest increase in the PCE price index. That's the Fed's preferred indicator. Estimates range from 0.1 to 0.2, both pretty tame. Evercore ISI saying, although we expect tariffs to eventually lead to higher inflation, repeatedly soft inflation prints could suggest weaker than expected tariff pass-through, marginally reducing upside risk to inflation and lowering a bit the bar for the extent of labor market weakness the Fed would need to see cuts in September. But what about this tariff mystery? One idea, they could be absorbed in profits by exporters, wholesalers, and retailers, with only a bit reaching the consumer. They could be offset by price declines in other goods because of economic weakness or other issues like what led to airline fares declining. And of course, there's this story of maybe they are still to come. Markets looking more confidently, you can see, for 2 rate cuts this year with a roughly 75% probability of cuts in September and December, both higher after the 2 inflation reports of the past few days. But note, the probabilities remain low for July, so the consensus is that the Fed is going to wait a couple meetings to be sure, Kelly, that the tariff mystery is solved in a good way before cutting. Kelly?
And, Steve, here's what the president said about Fed Chair Powell, speaking from the White House just a short while ago.
If we would lower the interest rates by 1 point, we'd pay about 1 point less. That's $300 billion a year. But I'm not going to fire him. We want to get rid of inflation, and we have. But we're going to be paying more for debt. And all he has to do is lower it. Europe's done 10 lowerings. We've done none.
So, Steve, he's now...
Of course, Kelly, I find that amusing because I wrote this 2 weeks ago, that if the Fed were to lower or the interest rates were to fall a percentage point, but I wrote that in context of if the Fed is not cutting rates because it's uncertain of the impact from tariffs, then the president should get rid of the tariffs so the Fed could cut rates, and it would be a better deal in terms of the fiscal
outcome
impulse into outcome in terms of treasury in the treasury market.
So in other words,
you just do better, you pay less on rates.
But the president's going to say,
go ahead,
so he'd probably say, well, I want my $300 billion from tariffs and I want my $300 billion from lower rates. But the problem is, as I see it, is kind of the problem from last fall. The Fed cuts rates before the market thinks it's appropriate, although it is priced in right now. You could get the long end moving higher, but the market is priced for it. So maybe this time is different.
That's exactly what I was going to say, Kelly. If you look at, for example, the 210 spread, it has been relatively steeper. So the market on the long end doesn't seem to be welcoming lower rates, and all the 2 years seems to be doing is reacting to expectations of the Fed. So it will go from 390 to 4, and it's in that range. But that 10-year seems to spike up to 450. I know we have that 10-year auction coming up. I think that's going to be important. But the long-term trend, I learned this from Santelli, by the way, is to look at the ranges. It looks like 430, 435 is the bottom end. 450 seems to be the top end around there, somewhere in that range. But the long end of the market is not anticipating, or I think, hoping for a big rate cut, because I think there is that still existent inflation concern that we have to work out over the summer.